What is proration? Proration is the division of ongoing property expenses, such as taxes, insurance, and HOA fees, between buyer and seller at closing, based on the portion of the billing period each party owns the property. What is proration? Proration is the method used at closing to fairly divide ongoing property expenses between buyer and seller based on their respective periods of ownership. Since many expenses are paid in advance or arrears, proration ensures each party pays only for the time they own the property. #common prorated items, expense typical billing, proration method, property taxes, annual, semi-annual, days of ownership, HOA dues, monthly, quarterly, days of ownership, homeowner's insurance, annual, if assumed by buyer, rent, monthly, if income property, utilities, monthly, sometimes prorated, interest, monthly, mortgage interest. #proration calculation methods. Method days in year, used by. Most accurate 360-day year, 360, 30-day months. Banking/statutory actual days, varies by month, per month calculations. #basic proration formula. Daily rate equals annual amount divided by days in year. Proration amount equals daily rate times days of ownership. #example. Property tax proration. Factor. Amount annual property tax, $3,650. Tax period, January 1, December 31st. Closing date, April 15th. Seller's days, 105 days, January 1, April 15th. Daily rate, $3,650 divided by 365 equals $10 per day. Seller owes 105 times $10 equals $1,050. #credits versus debit situation. Seller, buyer, taxes. Exam tip. Proration equals dividing expenses by days of ownership. Taxes in arrears equals credit to buyer. Taxes in advance equals credit to seller. No 365-day and 360-day calculations.